Hey, welcome back to the Data Driven Real Estate Podcast. This is episode 18. And this week we've got Charlie Doherty with Wells Fargo Securities. He is based out of North Carolina and he covers the commercial real estate, housing, and construction sector. And you can actually sign up in our community, which you never want to forget to miss. We've got links there on how you can sign up for emails with information that they put out consistently on the economy. And it's actually very good. This week we talk about commercial, how it's doing, everything from apartments to retail, opportunities, foreclosures, and if we're on the other side of the pandemic recovery. And if there's anything post-election we should keep our eye out on, you won't want to miss this week. Hey, welcome back to the Data Driven Real Estate Podcast, the podcast for real estate professionals dedicated to driving business using data. I'm Aaron Norris with co-host Sean O'Toole with Property Radar. And today we are happy to welcome Charles Doherty, Vice President and Economist with Wells Fargo Security. Thank you for joining us.
Hey, thanks for having me.
Hey, Charlie, explain a little bit about Wells Fargo Securities. I was not familiar with that branch of Wells Fargo.
Yeah, so Wells Fargo Securities is a part of overall Wells Fargo. This part of the overall bank is more involved in capital markets, investment banking, things like that. So we're our own kind of separate entity, but we are a part of Wells Fargo. So as part of Wells Fargo Securities, we have a team of economists, of which I'm a part of. So as I was just saying, we have about 13 people. We dedicate 100% of our time of following what's happening in the economy. We produce a monthly forecast for the economy, which ranges from what's going to happen to real GDP, what's going to happen to employment growth, what's going to happen to interest rates, things like that. So then we of course follow the incoming data that we get, and then we write our analysis. And I'll just sort of tell you where you and your listeners or viewers can find that. You go to wellsfargo.com/economics. All of our reports are there. They're all free. You don't have to be a client. You can sign up for our email distribution list. You can choose what type of research you're going to receive, whether it's housing or commercial real estate, or maybe you're just interested in what's happening with the Federal Reserve and monetary policy. So you can sort of curate your list to what your interests are. So again, wellsfargo.com/economics. You can find me, all my information there. But that's basically what our group does, and that's what we focus on every day.
Do you guys publish everything out there, or is some stuff only for clients?
As part of the economics group, it's all out there. It's all publicly available. There's other parts of our research, like equity research, that's just for the clients. But the economics part is widely available.
I did post links in our community to how to sign up for that very easily. I was actually turned on to your work by our CMO at Property Radar, and so I get your emails all the time on anything on housing, and it's impressive. You guys do some really great work. Now, your specialty is specifically real estate and commercial. How did you fall into real estate?
So I've been following real estate for quite a while now. I really started, I used to work for a company that sort of compiles economic data, and I was part of the regional group. So you have the national economy, and then sort of separate from that, you have what's going on, at a regional or local basis. So I was in charge of covering different individual markets, what's going on in their economies. So of course, part of that is figuring out what the real estate is doing in those local economies, because it's such an important driver for the rest of the economy. So that's sort of where I first started, covering real estate markets. And then soon after that, I worked for a very large building products manufacturer. And they make basically everything that's surrounding you right now: walls, ceiling tiles, basically everything, right? So as part of their group, but basically what I was tasked with doing was sort of following all different types of residential and commercial real estate, because they were, the entities that were buying our products. So that's sort of how I transitioned from, there to now, where I, primarily am focused on, the sort of what's ongoing and what's happening, with both residential and commercial real estate.
Okay. And what's Wells Fargo's primary reason for, you're creating this research, putting it out publicly? Is it kind of a marketing effort, or are they using it in internal decision making, or client decision making, or how does your work typically get used?
So I would say all of the above. Certainly internally. Think about what's happening, right now, when everybody has so many questions on what's happening with the economy. So right now we spend a whole lot of our time speaking with clients and customers and trying to, relay our insights on what we think is going to happen to the economy over the next few years, because everybody is sort of wondering, what's the trajectory of the economy, what's going to happen, it's a big question. So that's sort of how we get put to use. Before, COVID, pre-pandemic era, we spent a lot of time traveling on the road and going, in person and sort of explaining, our economic outlook and explaining, how we think the economy is going to fare, how we think housing markets are going to fare at a high level. To answer that question, I think it's really all of the above.
COVID. I guess we should jump in. Are you surprised where we're at today, maybe compared to 6 months ago?
It's if you kind of go back in time, right, to February or March, when everything really started to, pick up speed here. It's been a long 7 months, and it's, I don't want to say it's gone as expected, but I think if you listen to what the experts were saying in March and April, this was always going to be, more of a long-term event than what, a lot of people were initially sort of expecting. We knew it was bad. We knew it was going to take a long time for them to, develop a vaccine. Reports are now that saying, okay, we have over 200 vaccines under development worldwide. Hopefully, fingers crossed, one of those things works. But from the onset of this, we knew it was going to be, very serious and very, very bad in terms of a public health perspective. In terms of, the economy, that was probably more of, it's still sort of a big question mark, frankly, right? Because heading into this, how we sort of forecast what the economy is going to do is, we plug prior economic data into an economic model, and that sort of susses out the trends and tells you, what the current trends are how they're going to take you over the next, over the short term, and that'll give you, a forecast, right? So what happened with COVID is basically all of the economic data got so bad and deteriorated by such a large extent that it essentially broke all of our economic models. So that made our jobs much more difficult in forecasting the economy, which is, part of what we get paid to do. So it has been a challenge because, this is such a historically unprecedented situation that we found ourselves in.
In the commercial space, what are some of the key data points that you're looking at that were just completely thrown out the window because of COVID?
So actually, commercial data kind of tends to lag the rest of, the economic data that we look at. So one thing I was just talking to somebody about is, are the cap rates, right? Cap rates haven't really done anything. Property prices haven't really showed much movement over the past 7 months. And, the reason for that is because of the just how crazy things have been. There's this huge gap between where buyers and sellers perceive values to be. So there's just no sales transactions. So you need those transactions to actually get the cap rate, get the property price, et cetera. So none of that's really happening because nobody knows what next year is going to look like. The way you derive value or you come up with the value of a building is the intersection of perceived values between buyers and sellers. So there's so much disagreement there that there's simply no transaction. So in the commercial space, there's actually, if you look at the data lines, there's actually very, or relatively few indications that any, like a severe crisis happened at all. Now, eventually the data will reflect what happened, but if you look at, what's happening with prices or cap rates, which is what, a lot of people in commercial real estate, focus on, that's not really showing anything. Now, if you drill a little deeper and if you look at what's going on, underneath the hood, if you look at things like, demand for commercial space or net absorption, or if you look at rents in different sectors, those are showing, quite substantial impacts. So, for example, we just put out a research piece on apartment rents, right? So if you look at apartment rents, since about February, what you see is in certain very large major markets, like the classic example has become New York City or San Francisco. You see apartment rents just declining at a very strong rate. Interestingly enough, in other parts of the country, rents are holding up better. But these are the sort of indications that the pandemic is starting to have a very huge impact on commercial real estate.
Yeah, I mean, I think it's a great point that you made. And it's like Bruce. Aaron's dad is famous for having told everybody to get out of the single family market at the end of 2005, beginning of 2006. I made a similar decision. And, but it really wasn't until, September 2008 that I think the markets and everybody else really realized the crisis, so that's, almost 3, plus years later. So these things do take a while to work through. It's one of the reasons I love real estate, right? Is because you do get, if you're paying attention, you do get to see some things ahead of time if you're looking at the right things. Drilling in on, so have you guys worked on models around like, okay, we are seeing some softness in rents, right? And so when we get back to a normal market where there's normal level of transactions going, right? And assuming those rents stay low, right? We can start to predict maybe what starts happening to prices and that kind of thing. Is that stuff you're working on, like various scenarios? Like, okay, if rents stay at this level, people are signing 1-year leases now, there's rent control in places like San Francisco. So even like a short-term impact to rents could potentially lock in long-term impacts on rents.
Yeah, we do look at that, and it's really hard to judge or even quantify at this point because there's just so much uncertainty out there. Going back to the whole rents thing, New York and San Francisco rents have come down. They've come down quite a bit. But the thing you have to keep in the back of your mind is they were pretty high to begin with. Right. So how far above equilibrium were they to even before the crisis?
But values probably were based on those high rents and an assumption that those rents would keep getting higher, right? And now that mindset's been burst.
Yeah, I would agree with that. And again, it's very sort of challenging, right? Because if you think about, where values are, for example, New York City versus, other parts of the country. I'm speaking to you from Charlotte, North Carolina, right? And what's been happening in New York City for the past few years, where there actually has been a population, out migration, right, for a lot of years now. And Charlotte has been on the receiving end of that, where we've had a large influx of population growth. So one, I'm not so sure, any of that was either baked into those, pricing models or not. I mean, assumingly that they are. But, one of the trends that we've kind of seen and we're kind of trying to determine now is, how much of what we're seeing now is just sort of an acceleration of pre-pandemic trends. So like I mentioned, the outflow of residents from New York City, which began 3 or 4 years ago, really, how much of that is just an acceleration now. So when you're trying to predict, okay, when's the turnaround? Where's the inflection point here? We might actually be closer to that than many people think, because we sort of saw this trend happening years ago. So we're kind of further in the ball game than many people think.
In California, we've spoken at the Apartment Owners Association for over a decade, and last year the question got asked: Are we in an apartment bubble? And we sort of asked the question to the audience: would you buy your current asset at the prevailing cap rates? And there was rolling laughter across the audience, and we're like, "There's your answer." And that was pre-pandemic. So were we just really taking advantage of cheap money and driving up rates to where it didn't make any sense in markets like New York's and California?
Maybe a little bit. The thing, going back, there was, some concern with property prices for, apartment buildings, especially if you look where all of the investment was made. Unfortunately, over the past decade, the investment was centered in these places that are now being hit quite hard, like New York, like San Francisco. So yeah, it's hard to say because, again, it comes back to a supply and demand story. The supply, we were building a lot of apartment buildings and prices were going up alongside that. If you look at the demand for apartments, heading into this thing, the demand for apartments was pretty strong. Now, I'm not saying that justifies the property prices a lot, everybody was seeing in the different markets, but demand for apartments was holding up, even past our expectations, at least, because we were saying for years heading into this thing that this was a potential area of weakness within commercial real estate. But demand kept, sort of surprising. And I think it's a demographic story when it sort of comes down to it. And I think that demographic story is still, largely going to hold moving forward, right? The demographic story is, if you look at, if you break out the population by age, right, we have a whole lot of baby boomers and we have a whole lot of younger millennials. Well, those two segments of the population, a lot of them are actually, tend to be renters, right? So if you're just graduating college and you're going out into the job market, you're probably renting an apartment. If you're a baby boomer, maybe you're sick of owning a house, you're sick of taking care of your backyard. You want to be around all the restaurants and, cultural amenities that, urban areas provide. So that's sort of this inherent demand for rentals, right? Now, how much does that change now that we've had this COVID-19 crisis and things are changing? It's going to change clearly, but again, there's just so many of this population, of these younger millennials and baby boomers who are looking to retire. That's going to support demand for apartments, as people leave center cities and the residential real estate market picks up. So I'm not saying like okay, apartments are fine, the apartment market's, in the clear, but I'm saying it's probably not going to be as bad as people think, just because I think the demand for apartments is a little bit stronger, than what people realize.
We could, the pendulum's always swinging, right? So it's swung way over here to like get out of town, get away from everybody, right?
Right.
But after a year or two of that, like I expect people are going to be like, oh my God, I want to be downtown and I want to go to restaurants, after COVID's, cleared up. So I think that, the doom of one thing or the other is always kind of overstated and pendulum's always swinging.
Agreed.
Yeah, I definitely think there's going to be a lot of pent-up demand for, like you said, restaurants or travel. I do think once we get beyond it, it's going to be, it's going to be a little bit of a different story.
Has there been any research done on how long? So we're 7 months in, the work from home thing has become real popular. As people plant roots and get used to that, is this the new normal?
I think a little bit. With the way I kind of think about it, and I think other people are thinking about it, is, is everybody going to be working from home forever? No. Are a certain slice of people going to be working from home 1 or 2 days a week? Yeah, probably. Right? Because while, we have worked from home and it's been generally successful, I'd say, right, for both employee and employer, right? Employees have been more productive than they probably thought, and that's probably good news for employers. But it's really hard to replace, the office environment, as it is, and why, offices sort of emerged, as something that, we do in our workforce, right? So it's hard to replace the collaboration, the productivity, the innovation,
away from your spouse, away from your kids.
Yeah. That's the other side of it too, I think, is, some people like working at home, some people like working at offices, and they genuinely look forward to getting up and going in and being with their coworkers. They find themselves more productive in the office environment, and they kind of view it as sort of a second home, right? So they enjoy that, and that's part of, the contract where they say, I'm working for you, and I'm going to give you, 8, 9, 10 hours of my day, and this is where I'm going to be. So it's certainly, the office, I think, is going to still be the predominant, workspace, right? But I think what's going to happen is you're going to see this hybrid, workforce where, okay, you really don't have to be in the office, and if you do have to be in the office, maybe it's 1 or 2 days a week. So we're going to kind of keep up with this work from home policy. So that's probably more of the, the longer term thing that's going to happen. Because, on the other side, employers, because of everything that's happened, everybody's, facing these really large financial pressures. So employers are at the same time looking to say, hey, how can we reduce occupancy costs? So that might be a win-win, where you can reduce occupancy costs a little bit, but while maintaining similar levels of productivity growth that you saw beforehand. So again, that could be a win-win, sort of a hybrid workforce.
I'll jump a little into data, and so as a real estate economist, right, you're looking at lots of data, and what are your favorite data sets or data indicators or releases from others, or just, wide open there? What are the things that you like can't wait to get each day, each week, each month, whatever?
Yeah, that's a good question. So the vast majority of data or economic data that we look at are either lagging indicators or coincident indicators, just meaning that's what's happening yesterday or today, or what has happened last week or last month. But in those buried in some of these indicators are leading indicators. Leading indicators are by far my favorite thing to look at because they make my job easier because we have to kind of predict what's going to happen. So I'll give you an example. Yesterday, housing starts report comes out. Okay, the big number is, housing starts rise 1.2%. The bulk of the gain was in single-family construction, while multifamily construction fell in a big way. But underneath that, what we saw is building permits. So before you start anything, you have to file a building permit. So what we saw was, a big rise in single-family permitting and, some weakness in multifamily permitting. So that kind of gives you, if you think about permits, 90% of permits eventually become starts within a month or two. So that tells you something about what's going to happen next month with housing starts. So let's just say, now next month, single family housing starts are going to be strong and multifamily permits or housing starts, might be weak. So that's, an example of that. Another example is, today, mortgage applications came out. So this is another favorite indicator of mine because they come out every single week and they tell you, what's the demand for home buying out there. So, we saw this really strong, recovery in purchase applications since about April. They've kind of leveled off in recent weeks and they kind of continue to soften a little bit. So that tells us, it's like, housing market, people are still buying homes, at a pretty rapid and strong rate. But the fact that mortgage applications for purchase have sort of come down a little bit, that means, we're not going much higher. It's still going to be strong, but we're not going to continue to be on that growth path that we were on just a few months ago. So those types of leading indicators, I think are, my favorite what I get out of bed for.
Awesome. And what else, maybe a kind of a top 5 or 10 list of other things you watch, the forbearance data. And are you mostly looking at data that others have compiled, or are you looking at raw, data like public records, data and that kind of thing as well?
So all of it, right? So one sort of interesting thing that's happened, going back to, COVID broke our economic models, is we, as an economist, we are looking for any type of indication that might give us, direction on what the next few months are going to entail. So that means looking at every possible data source that we can find and sort of judging on how valid or how robust that data actually is. So we look at a ton of sort of, what you might call like a high frequency data set. For example, Google has a lot of high frequency mobility data. There's a company called Homebase that gives indications of how small businesses are doing in terms of hiring. So we're looking at all data across the board, and sort of this interesting thing that's happened is we've come to more rely upon that sort of all these alternative data sets to sort of help us form judgments about what's going to happen.
How close do you pay attention to politics at the state level? So California example in the commercial space is considering the Proposition 15, which you do is split roll taxes and has the potential to change some values, I would think.
Yeah, we do pay attention to local, state and local level, politics. We stay away from propositions and things like that, or potential policy changes, just because there's always different things floating around, and you're never sure if they will actually come to, fruition. So we kind of stay away from, those sort of granular type, propositions where, we're not exactly sure what the impact's going to be because of all those different factors. So, we pay more attention to, what's happening nationally. Of course, we've got a big election coming up. We've done a lot of work on trying to figure out, how that's going to impact the economy, how it's going to impact certain areas of the economy. It's very difficult because, again, it's 2020. Who knows what's going to happen? Once we actually know, the who's going to be in place, then we can kind of start to really dig in deep and say, okay, this is how X affects Y, this is how Y affects Z, et cetera.
You mentioned we talked to Doug Duncan a few weeks ago, chief economist at Fannie Mae, and he said one of the things they worry about for housing is what the impacts to small business are going to be. And you just mentioned small business. It sounded like a company you looked at for small business hiring. What about closings and openings and is there other things there? Or how much do you look at that small business data and how does it play into your housing models or real estate models?
It plays more into, the judgmental aspects of our models. What that means is, we have models and we have very specific variables that drive the models. Small business formation isn't a big part of those. But we do have this judgmental aspect where we can, look and see what's happening, at a large scale and say, okay, this might affect, this housing market, or this might affect, demand for office space. So it's certainly something we pay close attention to, more on a national scale. Wells Fargo actually has a small business survey that we release on a quarterly basis. So that's shown, generally what you would expect, where we saw, small business confidence kind of, plummet earlier in the year, and it's come back, but not to the extent where, you could say there's a full recovery. Overall, I think we're all aware at this point that small businesses are probably been more impacted by everything that's happened, compared to, larger companies with bigger balance sheets. So, there's not a whole lot of great granular data on this. One of the things we're actually looking forward to, which will provide more detailed estimates, is, the 2020 census, which should give you a better, indication of business formation and how actual counts of, small businesses have either, grown or declined as a result of this pandemic. So of course it's important, there's a whole lot of small businesses out there. It's a big thing that's going to have long lasting impacts. We just don't have all the data to sort of quantify what those impacts are going to be.
Is there any concern about the census data being impacted by COVID at all?
I think so. I mean, if the census is a very, very important thing that we do in this country, because a lot of the data that we get is sort of derived, either directly or indirectly from census counts. So it's extremely important for a whole lot of things. And if you look at sort of some of the data that the census has been collecting over the past 7 months or so, you can tell there has been an impact, and not necessarily, it's not the fault of the census. It's just they have to go and a lot of the times, either make phone calls or figure some way out to contact, households to get this information. So one of the things that happened, if you pay attention to home ownership rates, right? If you know what happened in the last quarter of data that we got, it showed the strongest rise in home ownership, on record, right? So that's what the data says. Now, is that data correct, or is it as correct as it could be? Probably not, because if you look at what the census said, they kind of admitted, they said, hey, we can't go house to house anymore because of social distancing and, these new COVID norms. So, we relied on phone calls, and we got a very low response rate. That low response rate makes, us making, or an error, makes it more likely there's an error in this data. So this is the data. This is what we collected. It showed a really strong rise in the home ownership rate. I'm sure home ownership did rise because of everything else that's happened that we can, we have better data on. But that's just one example of the challenges I think the census is going to have with collecting the data, and it's very important.
It could be it was just easier to reach homeowners than it was to reach renters, right?
Yeah, that's true. Yeah.
Coming back to small business, because you cover all real estate, not just housing, right? So we talked a little bit about multifamily and the outlook there. Where are you guys on, retail and let's start with maybe retail and office and some of those places that where small impacts to small business may have a pretty big impact on the underlying real estate values.
Yeah. So real estate or retail is one of those areas that it's sort of been in dire straits. Even before the pandemic, it was tough going, for a lot of the retail sector. And clearly, one of the biggest impacts there, and we're sort of seeing this even clearer now, is, competition from e-commerce retailers, like, all the big names, right? So, that unfortunately is going to cause some weakness in the retail sector, probably over the short term. Over the longer term, however, retail is the sector and it's this thing that's always been in the state of flux, right? So if you go back to the 50s and the 60s, that's when the malls started to, crop up around the country, big box retailers, and, before that, it was these huge department stores on every corner in every city. So there's always been this, continuous state of flux in retail. So, the way, I view things is, with e-commerce coming in and taking up an ever-growing share of transactions, right, in that market, eventually, we're going to continue. That effect's going to be there, right? We're going to see more retailers start to implement that and work with that. And we probably will see a turnaround, sometime, probably sooner than what most people are expecting, in retail properties that, things will adjust, I guess is my point. If you think of some of the things that we're seeing success beforehand, some of the retail properties were moving away from enclosed indoor spaces anyway, and they were more walkable and outdoor. I think that fits very well into, what a post-COVID environment will look like in terms of retail space. Because I think people still like to go to retail stores, right? There's obviously things you can do, more efficiently online. More of that stuff will move online, right? But people still like to go and try on clothes to a certain extent, to engage with different products, learn how to use them. If you look at younger demographics, Generation Z, there's some early evidence that they, sort of like to go out and experience, in-store shopping more than other generations. So I think the turnaround in retail is probably coming a little sooner than what people would expect. That's not to minimize, retail. It certainly has a few headwinds ahead of it. But I think that turnaround's coming, sooner rather than later. So for
hanging at the mall isn't over yet.
Yeah, right. So there. And if you look at other, types of commercial real estate properties, we talked about offices a little bit, and I think, the big thing that's sort of limiting offices right now, is again going back to this uncertainty where, nobody really knows when that return to the office is going to be. We're fairly confident that, people will eventually go back to the office, and I think employers are, sort of anxious to get their employees back to a certain extent. So it's just that it depends on the timetable for the virus, which, frankly nobody really knows. Probably next year at some point, that's when companies will have more an idea of how much office space they really need. They'll probably have firmer plans put in place with, okay, this part of the workforce is going to stay at home, this part of the workforce is going to come into the office, we're going to do these rotations or come in staggered shifts, et cetera. Next year, that'll probably start to take hold. But the good thing about the office market from a high level is, heading into this thing, the office market was in a pretty good spot. Now I'm talking about in terms of supply and demand. We all know what can happen when you have an imbalance in either of those, either too much supply or too little demand, or vice versa. So the office market was really balanced, as of early 2020. Right. So when you're coming in from a position of strength, that's going to allow you to recover quicker. So we weren't overbuilding. We didn't build too many offices, over the past 10 years. So hopefully that, that sort of seeds the ground for faster growth sooner, which would be a good thing.
While we're talking about office, I was just thinking, the company brand I have not heard of in a while, WeWork. Is co-working sort of passe now, or is that 2019, or are we going to see a comeback?
That's a good question. That was certainly an interesting trend that we saw, over the past few years. And then, if you just think about, what's happened with, in terms of social distancing and just a general aversion to, enclosed indoor spaces, that would make me, more pessimistic about, co-working, rather than being an optimist. So I do think it'll be challenging for co-working companies. And it wasn't just WeWork. There's a whole list of co-working companies that are in basically every major market. And what they kind of have to offer is kind of interesting. And I think one of the good things about co-working space was always that, it wasn't just, for entrepreneurs or people, starting their own businesses or things like that. We saw some really large companies leasing up or subleasing space, with some of these co-working companies. And we actually thought that was good, because if a company was trying to test out or stick their toe, in a certain market, they could go in and, lease up or sublease some space for, and not make that longer term commitment. So I think, it kind of greased the wheels a little bit of companies expanding their footprint, which I think was a good thing. Unfortunately, everything that's happened over the past few months, kind of will make that challenging moving ahead.
Hospitality.
Yeah, I think we actually, I have a tenant in one of my office buildings is a co-working space, and he is desperately trying to expand because he can put fewer people in, and he's got more demand than he's ever had before. But we are in a little bit different situation. We're in a resort town that everybody is moving to, and then realizing, okay, I got to get away from the kids, whatever. Yeah. So it's a little bit different, but there's co-working, but I also wonder about, like, if this desire for, I think one thing that might come out of this is for businesses to have a desire for greater flexibility. So maybe changes in leasing terms going forward, and changing in, rather than vanilla space that you come in and spend so much money building out, co-working kind of pre-builds out these really beautiful spaces for you and gives you a more flexible term than you'd get normally when you take over floors of a building or an entire building. Do you think there'll be a trend more? You think we'll see some changes in the underlying contract terms going forward?
Oh, yeah. Without a doubt. If there's anything, I think we're starting to see changes around the margins, right, with a lot of everything. But certainly for, leasing terms and things like that. Hard to say what those, larger scale impacts are going to be. But, if there's one thing we know, changes around the margins can have really big impacts. So I think, of course, we're going to see those, types of changes as sort of companies adjust and, occupiers sort of figure out what they need and what's going to work best for them. So yeah, absolutely.
So landlords that want to stay ahead of it and don't want to have vacant space should start thinking about air filtration systems and, maybe pre-designing space to be a little bit more COVID friendly, maybe a move back towards individual office versus so much open space. Some of those kinds of things might impact even what gets built going forward, right?
Yeah, higher rates of technology adoption is something we see a lot of companies doing. It could be as simple or maybe complicated, I'm not sure, but as, installing specialized buttons on the elevator or something like that so you don't have to touch it or things like that, or installing, generally just more technology that allows you to, abide by all these social distancing requirements that we're going to see, and surely all these companies are going to need to implement. So that's just one example, I think, of something that companies should probably think about moving ahead.
I think a lot of people spend so much time thinking about all the negatives of this, but there are a lot of positives and a lot of opportunity as well. I think even for those building owners that maybe are, struggling right now, if they look at the opportunities and the way to do things differently, right, they probably are going to be the first to recover.
Yeah, I think that's true. I always try to light a candle versus cursing the darkness, and it's looking ahead. There are definitely a lot of things that could be positive coming out of this. Especially, across a broad number of commercial real estate properties. And one thing that we're kind of seeing right now, industrial properties are doing very, very well. So this is another trend that we saw before. There has been an impact for sure from, just the drop in global trade, which, a lot of industrial properties are involved with. But if you think about, what's happened to retail, and the opposite end of that is, we need a whole lot more warehouses and distribution facilities and assortment centers and things like that. So right now, as these companies, as these e-commerce companies sort of continue to expand, what we're seeing is these more and more warehouses pop up, not just in the outskirts of town, in wherever the real estate's cheapest, but they're getting closer and closer to basically every major market. So that's, of course, to get, as fast as delivery as possible. So that's a huge bright spot, and that's probably not going anywhere, for a long time. So if you're looking for, things to look forward to, this rapid acceleration into e-commerce and for companies' abilities to ship things to customers in a very rapid time, that's here, and that's going to be something that is going to be a big positive moving ahead.
Hospitality space, any opportunities there that you're seeing?
Yes. So clearly hospitality is, it's if not the most impacted part of our entire economy right now, is hospitality, hotels, restaurants, large event spaces. Unfortunately, it's going to be a full recovery there is probably some ways off. You think that was probably the first to get hit, and it'll probably be the last to recover, unfortunately. And that's just because all of this is very close contact, in-person, type of activities. So it's just one of those things that's going to depend on fully defeating COVID-19 and the pandemic, and then we can start to fully think about recovery. I mean, we are starting to see, I was just looking at hotel occupancy rates nationwide, right? And we've seen hotel occupancy rates have come up, right? They went down, they plummeted really. They went down from, high 60s to, 20% around there, the deaths of the crisis. So they've come back up. The occupancy rate is right around 50% right now nationwide. But still, there's that, like I said, I was probably around 70% last year at this time. So there's still that gap that needs to be made up. And what can happen there? Obviously, I think people are a little, space confined and sick of being at home. So I think leisure travel probably picks up. I think people, are generally a little bit more okay with going and staying in a hotel than they were, a few months ago. They're probably not thrilled about it, but I think that's improving as we go on. The big thing holding everything back there, though, is international travel and business travel. So business travel probably isn't going to come back for some time. Again, that's based on the virus, and I think companies are going to be very cautious in sending people in a big way back out on the road. And international travel is sort of very similar to that, and I think officials are going to be very reticent to sort of open up the gates again, and that's just one unfortunate aspect of sort of where we found ourselves. So that's going to take a long time to come back. But I'm a little bit more optimistic on the leisure travel side. But unfortunately, if you think business travel is probably 20% of all travel, that's that 20% gap that won't be filled.
Is it really only 20%? I would have thought it would have been a higher percentage.
Yeah, so we looked at data from 2019, and that's what it was. So I'm sure it fluctuates, but that's the numbers we came up with, at least according to the ITA travel agency. But yeah, it's certainly a big slice, no matter what the actual number is, and unfortunately, it's going to remain very depressed.
Are you fairly positive overall on where we're headed? And is there anything, if it happened in the next several months, that you'd sort of step away and say, nope, gloves off now, this is a free fall?
No, I do think we are on the path to recovery, right? Which is where you want to be at this stage. Now, the question is, can we get where we're going faster? Or is there going to be something that slows us down? I think, if you look at the general, economic drivers that, kind of determine where commercial real estate or where residential real estate is going to be, those are looking pretty good, and we're still making gains. Now, the thing is, those gains are becoming smaller as we go, move ahead, which is one, a consequence of just the depths of the losses that we saw in the early spring. So it's only natural to have, some cooling or moderation there. But we are firmly on the path to recovery. It's going to be a long road. There are probably some things that could happen to get us back to where we were at the start of the year a little bit quicker. But right now, we think, if you think about GDP, the economic, growth that we kind of pay attention to, our forecast calls for us getting back to where we were at the start of the year, right in around 2021 Q3, right? So that's about 8 months away. So it's still going to be a little while till we get there, but we are on the right track. So I'm sort of, cautiously optimistic that we'll continue to sort of stay on that track, and then maybe we get some upside surprises as we move forward.
I had one more question. No matter who wins the presidential election, is there any thought that some people are just on the sidelines waiting for some kind of stability, or at least what the next 4 years might look like, to get off the fence, and maybe we'll see the numbers increase again.
Yeah, that's always a possibility. We did look, and it's really hard to say because just everything that's happened in 2020, it's just completely, it's just off, whatever. But
Off the charts.
anyway, we
Off
did
the
look
rails.
at the impact of elections and our economy, in prior years, and what we came up with is, do elections impact the economy? A little bit. Do the results of the election impact the economy more? Yes. So one, the election itself, if you hear reports saying, okay, the stock market's going to tank, or, we're going to go into economic oblivion if X, Y, or Z is elected, that's probably not true, right? But the outcome of the election, Republican, Democrat, the outcome of, the makeup of the Senate and the House of Representatives, that's all very important. That'll have an impact on the economy, but the election itself is not going to impact the economy. So we just have to wait and kind of see, okay, what are the results? How is that going to impact things? How is that going to impact, real estate? Because there's definitely a lot of important policy proposals that I think both candidates have, and that are, up for change, really. And that will have direct impacts. But we just kind of have to wait and to see, what those, results are going to be.
We are at that time, Mark. If one more time, if people could find out where they would best connect with you online.
So if you go to wellsfargo.com/economics, all of our information, our reports, our forecast, everything can be found on there, and you can sign up for our email distribution list and get everything sent to you directly.
Sounds great. Thank you so much for your time today.
Hey, thank you.
All right. Thank you for listening to the Data Driven Real Estate Podcast. You can find show notes and links to some of the resources mentioned in the show at datadrivenrealestate.com. Click that Join the Community, and you'll be forwarded to the Property Radar community, where you can ask questions about the current show and even see upcoming guests and ask questions there. We'd love to engage with you in the community, so check it out. Please don't forget to like, favorite, subscribe, and share on your favorite platform where you're listening to the show. It helps us out a great deal. Thanks for listening, and we'll see you next week.